So you finally bought your Florida dream home, moved in, unpacked, and life felt perfect. Until that property tax bill hit and your payments skyrocketed. Sound familiar? You're not alone. Thousands of new Florida homeowners get blindsided every year. And today I'll show you how to avoid it. Stick with me to the end, because I'm sharing a strategy that most people overlook, one that could save you thousands right at closing. In Florida, property taxes are the main source of revenue for essential local services provided by county and municipal governments, as well as school, water management, and special districts. Every January 1st, property assessors determine market value, or just value, of every parcel of property in the state. This is based on the home's quality, condition, and local market trends. Next up, the assessed value, where the appraiser ensures annual value caps are applied to the market value. For homesteaded homes, which are shielded from most creditors except for mortgages or tax liens, the Save Our Homes cap limits annual increases to the lesser of 3% or the change in the consumer price index. No homestead? You still get a 10% cap on yearly assessed value hikes. Keep in mind, properties are reassessed every year. Improvements like a new pool or even a new school can bump your assessed value. Think your assessed value is too high? Appeal it quick as deadlines are tight. The taxable value is your property's assessed value minus exemptions, and it's what your tax bill is based on. Local taxing authorities like counties and school boards set a budget and a millage rate to fund services like schools, fire departments, and roads. The tax collector then multiplies this rate by your taxable value to calculate the ad valorem portion of your final tax bill. The other portion is the non-ad valorem assessment, or special assessments or service charges, which are not based on the value of the property. Now back to those low taxes on the listing. They're based on the seller's setup. In Florida, a sale resets exemptions and reassesses the home at market value by the next January 1st. Since taxes mail in November and get paid in arrears, the seller's prorated share is credited to the buyer at closing, and the buyer's first bill mirrors the pre-reassessment value. The next bill can be a bit of a sticker shock, but the seller's low number wasn't magic. It was years of tax caps and exemptions you don't inherit. The best way to estimate your future taxes is to locate the property on the county appraiser website and look for a property tax calculator or estimator. Then simply enter the purchase price and any exemptions. Now on to exemptions. Florida homeowners can claim what's known as a homestead exemption if they own the property and establish it as a primary residence for them or their dependents. This exemption cuts up to $50,000 off your home's assessed value for tax purposes. $25,000 applies to all property taxes, and an additional $25,000 applies to non-school taxes on values over $50,000 with annual inflation adjustments. Here's something almost everyone overlooks: portability. If you're moving from one Florida homestead to another, you can take your Save Our Home savings discussed earlier. That means transferring the gap between your old home's market value and assessed value to reduce your new home's taxable value. Done right, this can slash your tax bill from day one. Further benefits are available to property owners with disabilities, senior citizens, veterans, and active duty military service members, disabled first responders, and properties with specialized uses. Please reach out to me for details. When a property is sold, sellers pay a one-time documentary stamp tax of 70 cents per $100 of the sale price to fund state programs when transferring the property title. For mortgage buyers, this one-time transfer tax is charged at 35 cents per $100 of the loan amount, in addition to an intangible tax charged at 2 mils or 2 cents per dollar on the mortgage. So how do you actually pay your taxes? Most homeowners use an escrow account where part of your monthly mortgage automatically goes toward taxes and your lender pays on your behalf. Some lenders require this, while others allow you to pay directly. Just make sure you know your options and deadlines. Before buying or selling, make sure to speak with a tax expert to uncover exemptions or negotiate transfer taxes. It could save you thousands. If you found this video helpful, subscribe now for more insider strategies that make navigating real estate simple and profitable. Drop a comment below and let me know if you're buying, selling, or just here to get smarter about property taxes. And don't forget to ring the bell so you never miss a tip that could save you money. See you next time.